Our next speaker, ladies and gentlemen, is Anna Bligh. She was the Premier of Queensland from 2007 to 2012. She's led the Australian Banking Association through critical reform as its CEO. That agenda has included delivering on the recommendations of the Banking Royal Commission and driving the industry's response to COVID-19. Anna was awarded the Companion of the Order of Australia in 2017 for services to the Parliament of Queensland and as an advocate for education, the role of women in public life and services to the not-for-profit sector. Would you please join me in welcoming Anna Bligh?
Thank you. Great. Good afternoon, everybody. It's a great pleasure for me to be with you, and I thank the NFF for the opportunity and the invitation. As understandably, I'm going to talk to you a little bit this afternoon about banks and finance as it applies in your sector, much of it will be known to you. Hopefully, there's some pieces of what's happening in a very fast-moving banking and finance environment that gives you some pause for thought as well. Great. I'm just making sure this is working. We've been working very, very closely with the NFF for a number of years. In the last 2 years, we've seen Australia's banks play a very critical role as shock absorbers against the economic shock of a global pandemic. We've been providing support during droughts, floods, fires, pandemic, and I think it would be fair to say that the full impact on the agricultural sector of the floods that we've seen in the last 4 to 6 weeks have really yet to be counted and understood, and that there will be a need for banks who are banking customers in those regions to be working at a very one-on-one level to get them through. We've been working, as I said, with the NFF for a long time, but to be fair, I think what we've really done has been working together on issues by issues, and we've always, sort of dealt with things on a very piecemeal basis. Tony Marr and I had a conversation about 18 months ago now and said, it's time to put some structure around this and to formalise it and to make sure that we don't wait for the next issue to come along, but that we're meeting regularly and we're setting ourselves we're setting goals for ourselves, and we're putting some discipline and accountability into the relationship. So we now have established an ABA, Australian Banking Association, and NFF roundtable. We've agreed to meet at least twice a year. That roundtable brings together senior representatives of the National Farmers Federation from each of the state agricultural organisations and the heads of Agri-Business lending from all of our banks who do lend into the agricultural sector. So the most senior bankers in the sector are there at the table, and they're becoming very fruitful conversations. Banks acknowledge that they've also got a very important role to play in supporting the NFF's vision, the roadmap 2030 goal to exceed 100 billion in farm gate output by 2030, and I'll come back to that more as I conclude my remarks this afternoon. As I've said, Australia's banks, and many of you and many of the people in your communities and their families will be able to point to a very long history of relationship with their bank and supporting businesses through difficult times. But I think it is important that I, on behalf of my member banks, acknowledge that they haven't always got that right. We are now 3 years on since the Royal Commission into Australia's banks handed down its final report, and a lot has changed. It is not 2019 in Australia's banking environment anymore. Well, for a start, what we have seen is an extraordinary amount of new legislation, rules and regulations added to the regulatory environment to ensure that Australia's banks are playing much more carefully inside the guardrails. So the National Consumer Credit Protection Act has more than doubled in size. In total, we've seen 200 new pages of legislation. Along with those 200 pages is another 300 pages of regulations and guidance from regulators. I think it would be important for me to acknowledge no industry wants to be further regulated, but I do think most of our member banks would acknowledge that these new protections give Australians' banking customers, whether they are retail or business or agri-business customers, more rights and protections. There are some very specific new provisions in relation to agri-business lending. And these have been taken on, these were recommendations of the Royal Commission, and they have been incorporated into the lending principles of all ABA member banks. And they are that distressed loans should be managed by experienced agricultural bankers, that default interest will not be charged in disaster and drought circumstances, or where there is no reasonable prospect of the loan being recovered. The principle is now clearly stated in the lending principles of every bank that the best way to manage a distressed loan is on the footing that working out that loan will be the best outcome for the bank and the borrower, and enforcement will be the worst outcome. Which is not to say that no banks are ever going to enforce a loan, but it really is importantly now very explicitly stated that it is the course of absolute last resort and after everything else has been tried. Appointment of receivers, also seen as and stated as a remedy of last resort, a commitment to offer farm debt mediation as soon as a loan is classed as distressed, so a long way before we get to some very hard decisions. And the Australian Banking Association supported the Royal Commission recommendation that we should have a national farm debt mediation system in this country. We're not there yet. It hasn't been possible over the last 3 years to get every state and territory to agree, but I do want to acknowledge that a lot of work's been done by a number of states and territories to further align their own state schemes, and that we are in a much better position than we were in 2019 when it comes to resolving these sorts of issues through mediation as opposed to enforcement. And we'll continue to advocate for a national scheme that gives certainty to farmers and agri-business operators wherever they happen to be living and working in the country. As you know, we've been through an extraordinary time with COVID-19. I referenced earlier, Australia's banks have taken the opportunity during these last couple of years, I think, to really demonstrate to the people of Australia that they listened and they learned from the Royal Commission. They were given an opportunity to think about how best to support customers in the very frightening early days of the pandemic. And as you know, we've gave an offer to defer people's payments on loans, business loans, personal loans and mortgages. We saw almost 1 million customers in 2020 take that offer up. We saw $245 billion worth of loans deferred at the peak of that concern in July 2020. What I think was really important, there was a lot of customers who were facing very uncertain times. People whose workplaces had been shut down, who didn't know if those workplaces would ever operate again, or if they were going to operate, how long that might take. I think, if you cast your mind back to, say, July 2020, if you worked for something as big as Qantas, it was hard to imagine that we wouldn't one day get that airline back up and running, but it was hard to imagine when that was ever going to happen. And as it turned out, it's taken more than 2 years. So very uncertain times for a great many customers, and that required a lot of investment. Banks hired an additional 5,000 staff over 2020 and 2021 to put into direct customer-facing areas, particularly into call centres. Every one of our banks who operate call centre functions had an extraordinary uplift in customers wanting to talk to someone, largely because customers were locked up and they couldn't get to branches. They could still use their online channels, but if they were worried about something and they wanted to talk it through, they were starting to pick up and use the phone. And interestingly, that they haven't stopped. It hasn't as we've opened up borders and economies and branches and shopping centres are all opening again. Banks are still experiencing customers who got very used to talking to their banker on the phone, doing exactly the same thing post-COVID. And banks are continuing to work with a number of farming customers. As you all know, there's a lot of good things happening in your sector at the moment, but there are still some customers affected by drought, and there are certainly some that have been affected very badly by fires immediately prior to COVID, and some that are now in dire circumstances because of flood. As we've rebuilt the economy, there's been some, I think, really terrific stories of what can happen when people think laterally and when banks back them. So I want to show you this one example.
My father and mother started the business in 1976 in the Hills District. On this site we grow onions for seed production, we do tomatoes, upwards of 30 or 40 varieties a year. We do cucumbers, pumpkins. We produce, I would say, billions of seeds per year that we grow here or we export. There's a growing need for organic seeds throughout the world. The pandemic has hit us hard in more ways than one. We were completely overwhelmed with the amount of seeds that were leaving our premises. It was almost like people were stocking up. It's like, right, it's available, let's buy it. We were working 7 days, but that in itself created some problems for us. We were running out of stock. With our seeds, we source a lot from overseas because we can't grow everything that we sell. But then we had the added problem, there were no flights coming in. And that was scary, to think that your business might have to shut down because you've got nothing to sell. We had some thoughts around how we could best reduce the stress on our staff by implementing some new machinery. So we spoke with our bank manager. They knew our situation, they knew our business. They were there for us. You know, your business banking manager is somebody that knows quite a bit about you personally. They know how you run your business. They, without hesitation, said, sure, no worries, we'll get that ball rolling for you. Luckily, we were able to capitalise on that instant asset write-off and invest in equipment that we knew would benefit our business today, tomorrow, but also into the future. I bought the machine of my dreams. This machine will take up to 5 tonne of fruit per day. This is our tomato machine that came from Holland, eagerly anticipated for the beginning of our harvest this year. So up the top, our tomatoes go in. There's some beaters in there that break the tomato up. So then we've got some material that comes out of this chute, and down underneath is where our clean seed comes from. I got a text message at work, and my husband had sent me through a video of the first tomato going in, and yeah, all the boys had big smiles on their faces. It was brilliant.
So just one story, and there are thousands like it, where for many people COVID presented an opportunity and they needed their banks to be there and back them to grow, expand, to do things in different ways and to take on an innovative approach. So we've seen quite a lot of activity despite the pandemic. What we've seen at the moment, lending to agriculture now stands at $91.5 billion. That's almost a 10% increase, January to January. So that's very encouraging. Farmers, as I'm sure you all know, like everybody else, are enjoying low interest rates and increasing land values, although I know that increasing land values can be a double-edged sword for some. Currently, we're seeing high prices and bumper crops. We've also got $5.3 billion sitting in farm management deposit accounts across the country, and there are some 43,000 agri-business farmers who have a farm management deposit account. So more than $5 billion is not a bad buffer, and that policy is clearly working and providing what I hope is, a very important tool in financial resilience. We did see over the last couple of years drawdowns from those deposits, particularly during drought. That's exactly what's supposed to happen to them. But as we've seen crops, bumper crops on good prices, we're seeing those accounts start to increase again. We will have a much better picture of what's happening in agribusiness lending in about a month's time when the ABA will be publishing our first ever agribusiness lending report. We anticipate this will be an annual report because we want the sector to understand what parts of the sector are borrowing, what sort of things they're borrowing for, to get a better picture of that whole financial relationship. As I've indicated here, we're in the middle of good times for a lot of farmers across Australia, but banks understand that good times often don't last, that working in this industry is cyclical, and they know that they will need to be there when things, hopefully not too soon, turn for some parts of the sector. As you can see, we're not only sitting at $91.5 billion worth of lending into this sector, but that it is in a growth phase. We anticipate it will continue to grow, and we've certainly seen a very big turnaround since about the middle of last year, or just a little bit before the middle of last year. Some of that is, as you heard in that video, and I'm sure many of you will have experienced it, is being underpinned by government changes to policy on instant asset write-offs, and we certainly started to see a lot of lending being driven by people wanting to take advantage of that. I've heard some parts of the sector I've heard it being called a tractor-led recovery, and we've certainly seen a lot of lending into big and heavy equipment. But we've also seen a lot of lending into initiatives that are about building resilience and building sustainability, building storage capability, being more prepared potentially for the next drought. I wanted to make some remarks this afternoon about climate change, both the challenges and the opportunities. Unsurprisingly, Australia's banks do have to find an aligned position with global investors. Australia is and has always been a net importer of capital, so responding to what investors are looking for is important. But we also have to see Australia's banks align with international regulators, government action and agencies such as domestic regulators. Right now, the Australian Prudential Regulator, APRA, is in the process of undertaking a climate vulnerability assessment, or they are in the process of developing a climate vulnerability assessment tool. It's out for trial with our 5 biggest lenders, and what that will do is the idea behind it is to develop a tool that will help banks to act more accurately, more transparently and more consistently measure the risk that is in not only their own activities around carbon emissions, but in the activities of the customers and the activities that they are lending to those customers for. This is a very iterative process. It's a new area of activity for APRA. Agriculture is one of the sectors that the 5 banks that are trialling this have been asked by APRA to look at in their book, so that early on we will get an indication of how that tool measures. APRA is looking to publish, in terms of agriculture, they're focusing on beef, cattle, dairy and grain, and APRA is intending to publish the aggregated results and findings this year. So look out for that. I think it will help us all understand a bit better how the regulator is thinking about this issue. But banks have a very important role to play in supporting their customers as the whole economy transitions to a low-carbon economy. Many farmers across the country are already adopting best practices in sustainability and environmental stewardship, and many of them have been doing so for generations. Banks want to do more to partner with those farmers to help them innovate and accelerate their transition plans. There are now multiple examples of banks providing multiple examples of Australia's banks starting to think differently about the financial products that they offer in these circumstances. I'm just going to give you a couple of examples. They are by no means the limit of the list, but just to really, I think, to start to understand how banks are working in this space. Bendigo Bank for more than 2 decades has been offering green mortgages, and those mortgages have rewarded customers who purchased goods for their houses such as solar panels. They were rewarded with a lower interest rate as those solar panels came onto their homes. So it's not a brand new idea by any means, but it's relatively recently that our banks have started to pick up that kind of idea in the development of new financial products. Recently, you will have seen the Commonwealth Bank putting together a new product for one of Australia's leading beef producers, Stockyard, who have entered into a sustainability-linked loan with CBA. There are clear parameters in that lending product that will see Stockyard stretching towards identified sustainability outcomes in emissions reduction, animal welfare and people well-being that are significantly beyond their existing, albeit strong, baseline. Where those targets are met, pricing discounts will then apply to the cost of the loan. Similarly, Rabobank, and I know that the Rabobank CEO is here today, I'm not sure if he's still in the room, but Peter Knoblanche. Rabobank, it's not only loan products or sort of classic loan products, there he is over there. So if you're interested in this, you can go and talk to him. But Rabobank similarly is offering sustainability-linked line of credit facilities. They're provided, for example, to a global green coffee supplier. If key sustainability performance indicators are achieved, the interest rate on that credit facility is discounted. So you can see, I mean, similarly, not a loan product yet, but you might have seen an announcement last week whereby ANZ Bank have recently announced a partnership with Qantas, who the two of them together are exploring carbon farming on existing farms in Western Australia's wheat belt to look at how they might be able to combine their sort of financial weight to produce renewable biofuels. So that's still quite embryonic, that project, but it just is, again, an example of a different way for banks to be thinking. So I wanted to just conclude by acknowledging that your Roadmap 2030, which, as I said at the beginning, Australia's banks are completely behind and want to support, that roadmap has 5 pillars, and one of those pillars is in relation to capital and finance, and that there are three goals that are identified in that pillar. The first is that 90% of Australia's farms will have business plans, including succession plans, by 2030. That's currently sitting at about 38%, according to ABARES. So there's some really important work to be done there, helping and I think there's a role for banks to work with their farming customers to help build those business plans where appropriate. Secondly, the pillar identifies a year-on-year increase in equity investments in Australian farm businesses. That one's sitting at about halfway towards being achieved, and 90%, the final one is 90% of Australia's farms using multiple financial tools to manage risk. That's one's not as advanced as some of the others. So over the next 8 years, if we want to see that 2030 vision realised, Australia's banks understand that they're going to have to play a really important part in funding transitions, in funding innovation and in funding growth. And if, as the NFF has identified, there is work to be done on business planning, on the use of financial management tools, and on the development of different kinds of financial products, including equity, although not that Australia's banks necessarily want to take equity, but they will continue to work with their customers to look at the best mix of financing and financial products. So I see the period between now and 2030 as potentially one that is very exciting, one that does provide new opportunities for banks and farm businesses to work together, and in so doing, design products that, frankly, neither partner can even imagine right now. And I look forward to watching it happen. So thank you very much, and good luck for the rest of your conference.
Anna, just a couple of questions while we've got you. Curious to know where the line is on banks setting pseudo-regulations, if you like, when it comes to carbon abatement, environment, animal welfare, for example. How do you balance, or how do the banks balance supporting different sectors and also the demands, for example, of activist groups?
Well, I think probably the most important thing to acknowledge in those sorts of issues is that Australia's banks are fundamentally based, and the way that they price and design products is fundamentally based on their ability to assess and manage risk. And they look at the issues around, for example, climate change. What are the transition risks here? Yes, there's going to be transition risks potentially in changes to government policy. There's going to be transition risks as we move from one form of energy reliance to multiple forms of energy reliance. And if you're a bank and you've got a lot of exposure in this form of energy, and you can see there's a roadmap here to 2030 and then to 2050 where we're going to move into a whole lot of others, then you've got to think about how you manage that risk and how you transition out of a very high risk exposed area of industry. But I do think it's important to acknowledge also that for a long time, I think it's true globally and here domestically, banks and finance have seen climate change and the move to a low carbon economy often through that risk lens, and it's important. We want our banks to be safe and largely to be pretty conservative about managing risk. But I think it's increasingly true here and around the world that not only banks but equity funders and other forms of finance are starting to see, and not just a risk and a threat and a problem, but actually an enormous opportunity. And I listened to one of the panels earlier this morning saying, we've got a lot of projects that are very exciting in the agriculture sector, and we need to see capital come into those projects. I'm here to say there's a lot of capital looking for those kind of projects. There's a lot of banks who, they're not wanting necessarily to eliminate risk, but one of the ways you manage risk is to diversify and not to be overly exposed in an area that might be about to experience a rapid shift out of the economy.
Speaking of that, with debt levels and doing what they're doing and interest rates going the way they seem to be going, is the banking sector a bit scared at the moment?
Well, I think it'd be fair to say that all of my members understand, just like you understand with your customers, nobody wants to pay more for anything. They don't want to pay more for, steak at the butcher, they don't want to pay more for cereals, and they don't want to pay more for their loans. It's never a good moment when you have to tell your customers that the cost of your product has gone up. And if official interest rates lift, then yes, there will be an increase in the cost of money. That's what's going to happen. They're not fearful in terms of, it's not about to threaten the banking sector, but I think that banks have worked very hard over the last couple of years to really learn the lessons of the Royal Commission and to work much more closely in supporting their customers. And so, they'd rather not have to give them bad news, but, the RBA will only lift those rates if they think inflation has got to a point where it needs to be pulled back. So it is part of the balancing of the economy.
Just before we let you go, Anna, on that Banking Royal Commission, what is one practical example you can give us here today of how banks are working right now to prevent family farms from foreclosing or having to foreclose on family farms during the next drought, because it will come?
Yeah. First of all, I should say the number of foreclosures in agricultural businesses in Australia over the last, particularly over the last drought and over the last 3 to 4 years, you can measure in two hands. Like, this is not something that is, I think what we actually saw in real life at the end of the last drought, which was a really bad drought, what banks were able to do was look through the drought and see that if this was a good, strong, profitable farm beforehand, then it was likely to do so again and to kind of hang in there with them. And that's one of the reasons I think you heard people say this morning, what was successful was that farmers were sitting there ready to go as soon as it rained. Then, again, just proves that banks were right to see them as successful businesses ready to go. So in terms of practical examples, I think probably the most important is the work that's happening right now through things like the climate vulnerability assessment discussions, where bankers are sitting down saying, right, what do we need to do? Where were you vulnerable last time? What really kind of tipped it over to mean that you had to sell the herd, for example? And therefore, what do we need to do to make sure you're better protected next time? They're the real life conversations that are happening right now, and that's exactly why they're trying to develop these financial products that will incentivise the building and investment in resilience and sustainability.
Ladies and gentlemen, please thank Anna Bligh.